Hi, this is Stuart Weems, and thank you for listening to the Investopoly podcast. My goal is to give you simple, easy to understand insight, strategies and tips to help you master the game of building wealth. And in this episode, I'd like to talk about investment grade apartments in Melbourne in particular, but I suspect this would probably apply to the rest of the country as well, given the things I'm going to talk about aren't geographically just centred on Melbourne, but they apply across the country. Firstly, let me define what I talk about investment grade apartments. Investment grade apartments have the three characteristics of any investment grade property, in that more than 50% of their value is represented in land value. They've got scarcity in terms of architectural style and also in terms of location. So they're in very scarce, highly desirable locations, and they have strong proven performance. That is, we can go back and have a look at the growth over the last 10, 20, 30, 40 years, and it's demonstrated that it's got the capacity to generate 7% or more compounding capital growth rate. Investment grade apartments typically tend to be built before 1970. So we're really talking about Art Deco, something that was built in the 20s or 30s, right through to 1970, maybe a little bit older or newer than that, I should say. But that's the general range. So just so we know what we're sort of talking about, there'll be in blue chip suburbs. I'm not talking about any sort of high-rise apartments and so forth. So in February this year, I wrote a blog suggesting I thought they were intrinsically undervalued. And there's been a few things that have occurred over the last 6 months since writing that blog that actually cement my view, and I think make it even stronger that perhaps their investment grade apartments are really positioned for very strong capital growth over, let's say, the next 5 to 10 years. I mean, I don't know when it's going to happen. No one really does. And I'm not going to sit here pretending that I'm an expert and that I do know. But perhaps if I share my line of thinking here, you can understand where I'm coming from. So as always, you'll find all the information in the show notes anyway. But firstly, my first point is that houses have become very expensive in those blue chip locations that I'm talking about. If you want to buy a quality house in a quality street, you've got to be spending somewhere between 1.3 and say $1.7 million. You've got to be in that range. That's expensive, and not a lot of people have the financial capacity to be able to purchase at that range. But assuming people don't want to compromise in terms of location, and if they don't have that sort of money to spend, let's even just say north of $1 million to spend, then they're going to be forced into the apartment market. However, 5-10 years ago, that you could have spent sub $1 million and got yourself a decent, quality, well-located house. So therefore, what I'm suggesting is, because of the price points have changed, there's going to be a greater volume of potential purchasers that are now going to be forced to consider looking at apartments as opposed to houses. Now, you might say, Stuart, that's stupid. People, if they want a house, they'll just go a little bit further out. That's true, and a bunch of people will do that. But there are a bunch of potential purchasers that won't want to compromise in terms of location. And let's not forget, less people are actually having children or having children later. There's more single professionals living alone that won't necessarily want to live in a one-bed apartment, but are quite happy to maybe live in a two-bedroom apartment as opposed to a two-bedroom house. So I think there's still a large volume of potential purchasers in that range. The second observation, just to round that out, houses have performed very strongly in terms of capital growth wise over the last 5 to 10 years. There's anecdotal evidence that that's changed, that demand for quality houses in those areas has subsided. So what I'm going to talk about in a second is how property moves in spurts, in cycles, in growth cycles. Perhaps, and I'm not suggesting this is with any strength is accurate, but perhaps there's anecdotal evidence that maybe houses have had their run and now it's apartments' turn. Secondly, tightening credit. So obviously, as I've spoken about and written about almost ad nauseum over the last couple of years, credit is substantially tighter than it was, for example, 5 years ago. That compresses people's borrowing capacity and therefore pushes them down the rung from perhaps a house into the apartment sector. So we have to understand that this credit crunch will make houses even less affordable, notwithstanding obviously the price appreciation over the last 5 years or so, but also then the tightening of credit. Again, if people want to live in a really good suburb, blue chip suburb that has all the amenities that they've been used to perhaps as a renter, then they're going to have to compromise and they're going to have to consider perhaps an investment grade apartment. So I think that's one of the flow-on effects to this credit tightening. The other thing to consider in particular suburbs, and this is going to be very geographical, is the supply of new build apartments. And quite often there's a lot of literature and commentary around supply of apartments, and they'll quote numbers, 20,000 new apartments in Melbourne and so forth. Those numbers are good at a macro level, but really aren't that useful to you and I if we're contemplating investment in a particular location. What's more important is to consider how much supply of new apartments is going to come onto the market over the next 5 years. Now, typically you can ascertain that relatively easy because you know what developments have been marketed and what developments are currently being constructed. So for people in Melbourne, to give you an example, certainly over the last, say, 10 years, South Yarra and Paran have had a lot of development. But a lot of that development is now being built. There aren't a lot of new, very large new build developments. I mean, it's still happening in that area naturally, it will continue to happen for years to come. But it's sort of come to the end of that cycle where, 5 years ago there was a lot of current and proposed projects in the pipeline that haven't yet come online and had purchasers and own occupiers and renters occupy them. But you compare that to, for example, Richmond and even to an extent East Melbourne, there is currently still a lot of large projects that are currently in the cycle of being built. So that still needs to work its way through. So that's going to impair, because of the supply demand, that will impair growth in those suburbs, I think, in the shorter term. Now, that's not a reason not to invest. In fact, it might be a great reason to invest because of that demand supply, and you might be able to get in at a lower rate, at lower price point, I should say. But they're the sorts of things to consider. So ignore that macro data. It's really about looking at the geographical elements. Now, what I wanted to do is share with you an example of a particular property that I happened to be looking at this week because a client purchased it last month as an investment, and it's in Carlton North. And I looked at its past growth, and it actually demonstrated this point really, really well. Now, I understand it's only one property, so statistically it's not representative, or it can't make a great argument, and I'm not trying to make a great argument here, a great statistical argument at least. All I'm trying to do is demonstrate that property growth is almost never linear. And we've got to understand that geographical property segments go through different cycles of growth. They might be in a growth phase for a period of years, and then they'll be in a sustainable sort of moving sideways phase, and then they might enter another growth phase and so forth. So quite often the property market can move in very large chunks in very small periods of time. So that is a price of a particular property might be at a certain point, and then after a couple of weeks they're at a new point. And property prices move spasmodically like this. So I've profiled in the show notes a property in Richardson Street in Carlton North, and I've tracked all its sales since 1975. So there's 43 years of data there. And what I've shown is there have been sort of three periods of growth over that 43 years. So from 1975 about through to 1993, the growth rate was about just under 13% over that 18-year period. Then it had a period of consolidation, really moving sideways, with very essentially no growth for 13 years, and then a final period. So that was really between 1993 and about 2004, 2005. And then since that period, it's grown at 13% again for 14 years. So 18 years of very strong growth, 13 years of no growth, 14 years of very strong growth. And that's anecdotally how property markets move. Now, over the whole term, the 43 years, the growth rate has been 9.6%, which is a very healthy growth rate. I'm sure you would agree. But looking at and tracking and actually graphing the sales really does demonstrate how property works. So anecdotally, again, if houses have been through a very strong growth spurt, and if there's anecdotal evidence to suggest that perhaps is coming to an end, then what I'm hypothesizing is that perhaps apartments are going to have their day. Perhaps the market will swing around. Historically, over the last 5 years, it's been houses have been growing strongly, apartments have been doing nothing. Well, maybe that'll switch around and houses will do nothing and apartments will grow strongly. You've got to think also, if we look at Richardson Street, 9.6% of growth over 43 years, and you have a look at that time period from 1975, you come to appreciate that actually that property has endured a lot of challenges. Introduction of capital gains tax and the temporary abolition of negative gearing in 1985, interest rates of 18% or more in the early 90s, 3 economic recessions, introduction of GST in 2000, and a couple of massive share market crashes have occurred over that time period. But you can see during that time period, it's had periods of still very strong growth despite these things occurring. And in the long run, if you're a long-term property investor, you've been rewarded substantially of a capital growth rate of nearly 10%. So the credit tightening that we're having today and its impacts, don't be concerned as a long-term property investor. These things will work their way through, and at the end of the day, the fundamentals will rise to the top. There's always a strong trend of mean reversion. There's been a lot of studies about this, which suggests that if there's a period of no price growth, it's typically followed by a period of strong price growth. And again, a period of strong price growth is typically followed by either a correction or a period of no growth, which is kind of what we're seeing in the Sydney market, period of very strong growth. A small correction, maybe prices have come off 10%, and then it'll probably do nothing for a few years, price growth-wise. But the good quality properties will still continue to grow, albeit at a much lower rate compared to their longer-term average, but they still will hold their value. And all you can really do, I mean, no one knows when these periods will start and end, and I can talk about anecdotal evidence, and I could be right and I could be wrong, and really it's probably just due to random good or bad luck, not through any skill. No one in the world has developed a proven, reliable model to predict when these cycles will occur. So therefore, the only thing that we can do is invest in fundamentally sound assets. However, what I'm proposing at the moment is that if you're looking prospectively at a property market investment at a time when, you know, property's not that popular and interest rates are low and credit's tight, so contrarian view would be it's a perfect time to invest. And if you're looking at a prospective property investment and you're weighing up, should you buy a house or should you buy an apartment, all I'm saying in the cycles is perhaps there's evidence out there to show that apartments, good quality investment grade apartments, are undervalued. So next week's podcast is going to be, because this is a bit of a prelude, I need to get this off my chest. Next week's podcast is going to be what makes a better investment, a house or an apartment, and so stay tuned for that. Okay, until next week, see you later.